Welcome for another episode of the Foundation for the Study of Cycles. Today we have an industry colleague and friend, Simon Hunt of Strategic Advisors on global economy, including geopolitics, China, and the copper industry. Simon, welcome to you.
Well, thank you very much for having me. I'm honored.
Honor and pleasure as well.
I only hope that what I'm going to say is not going to depress everybody.
Winter season is part of the annual cycle, and as I've always been told, spring typically follows.
Well, we can hope that.
Yes, indeed. And of course, if I can just give a backstory for our audience. Simon, you and I have met before many times in London, where you have always lived, at the traditional Halkyn events, an investment community in London, which has been around for decades, since the 70s. And then since then, we've met in Dubai to have some interesting conversations about markets, but also global affairs. So great to be chatting again, but this time online for everyone to listen in.
Well, again, thank you for having me.
Okay, so if we could kick off, Simon, just as a general intro to your work, what you do, how you look at markets, and if possible, the integration of cycles. How do you look at the world of cycles, both in markets and world affairs?
Well, I've always, since I started my first company in 1975, that dates me, I've always had an interest in what is going on beneath the surface in the global economy and in how China fits into the economy and the geopolitical tensions that were always simmering and which are now threatening to break out. So it all started because in looking at copper, I had to look at what was real growth, not necessarily what was being published. So that has led me in more recent years into looking at how the cycles, the long cycles, are playing out. And in a recent piece that I did, I put together a number of cycles: demographics, the long wave economic cycle, the weather cycle, the war cycle, the inflation cycle, and the interest rate cycle. And to my surprise, they actually are all converging in or around 2028. So that does not mean that we won't have geopolitical tensions. The situation will remain very brittle and tense, but the ultimate blowout, I think, is going to be as these different cycles converge in or around 2028. Of course, what could bring the whole convergence cycle forward is that should one of the conflicts that are currently being built in the Middle East and Europe physically break out into war. But I think that, hopefully anyway, that won't happen for the next 3 to 4 years.
Certainly challenging times, and as we just mentioned at the top, the so-called winter season that we seem to already be in and will continue to prevail from. Perhaps if we look at the here and now and in the days ahead, Simon, new U.S. President-elect, Jan 20 inauguration, the whole market is holding its breath, it seems, with this election fever, this Trump 2.0 expectation. I've put in a little cartoonesque metaphor of some of that two-sided expectation. So clearly it's been positive in terms of the risk markets and the revival in animal spirits. But as we can see here, there's one bull in the boat wearing a safety jacket just in case. And according to some of the data that I was running ahead of time, typically there's this two-stage pattern which can be described as buy the rumor, fade the fact, particularly where there's an expected and positively positioned US administration that tends to be good for markets initially, but into the actual inauguration itself, there tends to be a profit unwind, but also a stress test in the first 100 days. What is your perspective both on this inauguration and the so-called Trump 2.0 effect and how that might impact markets?
Well, I think the first thing we have to recognize is that the American economy is not as strong as it's being made out to be. If you look at the employment data, first quarter was revised down dramatically. The Philly Fed, who tracks very closely real employment data, has come out with the second quarter being down by 0.1%. And that indicates pretty strongly that the second quarter was down. And then if we look at for the second half of the year, employment is falling. So I think you have in February, the BLS brings out its revised employment data. It's going to be weak. And then if you look at retail sales and deflate the nominal numbers, even by CPI, which understates seriously what real inflation is, retail sales were down last year. So then on top of that, you've got Elon Musk and the Doge, who will be firing the thousands of workers that the Biden administration padded the system to make the economy look better than it actually was. And then there's all this talk about Trump is going to, within 24 hours or a short period of time, is going to do a deal with Putin so that we have a ceasefire. The problem is that Putin has made it very clear what his position is. And that basically is he is looking not just for today, but 2 or 3 years down the road when America will have hypersonic technology or the equivalent, and therefore drawing a boundary line along the Dnieper River is not going to provide Russia's early warning radar systems with enough time before a missile is launched. So Putin has also made it very clear that it's the big picture that we need to focus on, because arising from the big picture, Ukraine will automatically fall into place. So what he's talking about is the restructuring of Eurasia. So what this all means to us is that these are going to be very difficult and protracted negotiations. There's no way that Putin is going to agree a ceasefire. He's had promises before and they've never been fulfilled. So, and I suspect also that NATO, even after Trump is in the White House, that NATO is going to continue to attack Russian territory in the hopes that Russia retaliates outside Ukraine, which of course would then draw everybody into a war. So far, Putin has been very restrained, and what he's doing is destroying much of the infrastructure, particularly power generation and distribution, and destroying command and control bunkers in which NATO officers are housed. So I don't see any quick settlement over Ukraine in the first 100 days or even in the first year of the new Trump administration. Then if we turn to the Middle East, you can put forward an argument that Israel will attack Iran on any day soon after inauguration or before it. The reason is that he is uncertain how Trump is going to react with Iran. He may try to impose more sanctions, more tariffs against Iran in order to try to effect regime change. Iran has stated that it won't be the first to make an attack, but if they are attacked, they will retaliate very strongly, and that will include hitting America's military bases in the Gulf. Iran has the missile technology and has the means also to defend itself, having been sent Russia's most up-to-date anti-missile radar system and the S-400. So my bottom line is I think that markets are going to fall quite sharply by September, probably with most equity markets, including the S&P, falling by about 20%, and the much-loved FANGs probably more like 40%. It's from that point, that Trump's taxes, deregulation, etc., will start kicking in the fourth quarter. And other governments will also be responding with fiscal and monetary stimulus. And I'll come on to China in a moment. So that we will then have about 2 years of roaring equity, base metal, and precious metal markets. But the problem is that this will be highly inflationary, which in turn means that by the time we get into 2028, we will probably repeat the experience that we had in 1980, when US CPI was over 13% and global inflation around 15%. But what does that do to long-term bond yields? The bond vigilantes hate it. So we will see double-digit 10-year US treasuries and comparable high numbers across the world outside China. And that will mean a crash in all asset prices in a highly leveraged system, where last year debt to GDP was 360%. So in a nutshell, that's how I see the coming few years.
Very good that you shared the big picture outlook right at the top, so the audience get a sense of your roadmap ahead, and certainly how tumultuous it will likely be if all of those tail risks do play out. And if I could play devil's advocate from a market perspective and look back at the market that has passed, we've had 2 years of back-to-back upside performance, record performance of about 20% on the S&P 500, the NASDAQ 40. I think it's doubled in value from the lows, and ultimately all-time high territory where euphoria has been the strongest it's been. So, Simon, my question to you is, when investors ask you, as they often ask me, why the disconnect, and what is fueling this irrational exuberance, and for how long can it continue?
That's a very, very good question, because euphoria nearly always lingers on longer than we expect, which is why I come back to saying that I think that the market is believing in the strength of the American economy, and that this will continue through the early part, if not later, of the Trump's administration. This is where I differ. The American economy is not as strong as it's being made out to be, and these will disappoint the bulls, and that's why you will have a good correction. And it's from that corrected base that we can see equity markets and base metal markets more than doubling over a 2-year period. You also have to think of, what does Trump like to see? He would much prefer to see the bad news being produced soon after he's in the White House, as he can blame it on the Biden government. And to take some of the flush out of the markets would also be good thinking on his part, so that he starts, say, in September on a much firmer base for the next 2 years.
Well, certainly looking at the market chart that we had up on the screen, Simon, there are signs technically of a trend reversal in play, based on literally the weak start to the new year. I think one of the weakest in recent times, but also a breaking of this rising channel as part of a wave 5 potential reversal for those of you who look at Elliott wave analysis. So that's the momentum exhaustion, potential trend reversal below 57.50 is the technical level, the pre-election gap period. Also, we have rotation fragility, where tech is still strong, but not as before, and the leadership isn't playing out as perhaps expected. And last but not least, the foundation cycle modeled in the bottom right-hand corner, showing a long-term top risk into this year. I was about to say next year. We're already in the new year of 2025. The big question is, will it happen in the first half, second half, and if so, what type of market will that be? So I'm sure these questions will be more clear closer to the time, but certainly they align with the themes and the risks that you mentioned there, Simon, perhaps more in the second half of this year and beyond, in terms of that multi-year view that you shared. I wanted to take a step back and feed through to the really big picture macro themes that you were discussing, which really go beyond a market top in the equity markets and this kind of irrational exuberance, and we start to really look back several hundred years, if not thousands, at this an empire of great powers, and perhaps not one power in particular, but a unipolar into a multipolar world, which is being voiced quite a bit by some thinkers around the world. The one model I'd like to share with you is by Ray Dalio of Bridgewater House in his book Changing World Order, where he actually pictures this rise and fall of empire. A whole lot of very interesting research about several other empires before it. Simon, this is something we've discussed in the past, but also I know you've been writing about for a long time. What's your view on the bigger cycle likely at play here and now?
Yeah, I think, well, there are three big cycles. The first is that at least since 1991, and perhaps even since 1946, America has always had an objective to dismember Russia in order to get control of Russia's huge natural resource assets. The second big theme is, which comes back to the empire model. The second big theme is that China is viewed as America's real competitor, and that in order for America to retain its hegemony, it must at least constrain China. The third one, and they're all interlinked, is that Washington now sees that if BRICS group of nations mature into a living animal as opposed to a theoretical one, then BRICS poses a real threat to America's position in the world and indeed the domination of the American dollar. So those are the big themes at play. The war in Ukraine is part of it. So the tensions in the Middle East are part of it, because Israel has been and will probably continue to be America's bridgehead into the Gulf. So I think that one of the big foreign policy themes of Donald Trump will be to try to break China's alliance with Russia, break them away, isolate Iran, because Iran is so closely tied in with China and Russia. So it's really step by step trying to disrupt BRICS from maturing into a real rival to America. I mean, they have already chipped away at Brazil. The large ministries in Brazil are anti-BRICS and pro-Washington. President Lula knows that one call from Washington and he could be back in jail. I'm told he has a young wife and would much prefer to enjoy the rest of his life enjoyably instead of being in jail. So far as BRICS is concerned, 2025, because Brazil heads up BRICS this year, there's going to be no real progress. Internally, there will be a lot. But I should note that just, was it today or yesterday, Indonesia has been accepted as a full member of BRICS. That is a very big deal, particularly in South Asia.
Interesting to note the multipolar world framework that clearly we're in, but that you're also spotlighting in terms of BRICS and their rise and the impact that is likely having on a global stage. One of the very difficult subjects that we try not to talk about because it's very heavy, and already we alluded to the winter season ahead, is this so-called disruption in society, macro environments such as inflation and an accelerated pace, but also exactly what you just mentioned there, the likelihood of war. And some people talk about World War III, or at least hot and cold wars and proxy wars. But here's looking at a cycle based on the work of Kondratiev, which is a well-known cycle for the Foundation for the Study of Cycle audience. Look it up online and in past educational work that we've shared. But essentially, we see that it shows up on CPI as well as interest rates and other markets, and typically leads to these inflection points in history. And here we can see already in the past, Vietnam War, World War I, US Civil War, Napoleonic War. This chart was previously featured with an interview with our guest, David Murren of Global Forecaster, also alluding to this next flashpoint of 2025 to 2030. Simon, what's your perspective about, well, the so-called inevitability of war based on cycles, how inflation feeds through that? And if I could just add a final twist, how does that challenge the Trump peace dividend?
Great questions. Difficult answers. My take is that we have simmering tensions through 2027 that don't break out into open war until 2028. But that's my best case. The worst case is that Netanyahu decides, I've defeated, or so he says, which he hasn't, I've defeated Hamas, I've defeated Hezbollah. Now I must go for the head of the snake. And he's uncertain about how Trump is going to support that, so that we have in the first 6 months of this year, the risk is that Israel attacks Iran. Iran will retaliate with a view to destroy, not to send a message, which was the case on the 2 previous attacks. The 2 previous attacks showed that Iran's missile technology was strong enough to evade all of Israel's and America's defense systems because they used hypersonic technology. The next time, the objective will be to destroy the targets. Then I was listening to a guy earlier today, very well-informed person, who was saying, watch out. You can well see Hezbollah starting to fire missiles at Israel before the 60-day ceasefire is up. So the risk is a big one that before 2028, we don't just have simmering tensions, we have war. But in my base case, that war does not break out until 2028.
And certainly looking at investor surveys, just in this last year, geopolitics was number one as a top concern in investor minds, compared with inflation, recession, presidential election, and more. And if we look at this other chart here called the infamous doomsday clock, look it up, we're officially 90 seconds before midnight. And so many geopolitical strategists are alluding to this for good reason, because basically things have not been this bad since World War II. So don't take our word for it. Look at what many other experts around the world who A, calculate this, but B, share an expertise in this space suggest. And that includes all of the hot regions that you just mentioned, Simon, Europe, Middle East. Asia is perhaps one to expand into during our chat. But if I could just ask the question, Simon, how high are the stakes? I mean, certainly it's hit headline news and it's been with us for some years. But late at night when you're thinking about this, how concerned are you?
Oh, very concerned. I mean, it's my primary worry before I fall asleep and when I wake up. It's not, is there going to be a war? It is, when is it going to be? Because you've got two mega, one an existing empire and the other an emerging empire with a group of countries behind him. And they both want different things. One wants, I'm going to continue to dominate the world. And the other says, no, sorry, we don't want that anymore. There's only one way to resolve it. That is to have a mega crisis, such as a war. And after that, heads can be knocked together. And then we have a multipolar world. But I don't see that happening until the early to mid 2030s. We have to go through the crisis first.
And just to play on that point, Simon, that you made, in terms of the sequential order of history and why much of this disruption is necessary, at least according to lessons of the past. If we go back to the empire cycle, spotlighted by several voices around the world, but in this case, Ray Dalio of Bridgewater House, he has revolution and war as part of the empire cycle. But once we progress from the debt bust and economic downturn, the printing money and the credit, and then revolutions and wars, both internally and perhaps proxy and global to follow. But your point there, debt and political restructuring before a new world order, which may be that multipolar world that you've alluded to several times.
Yeah. I think there is one cycle that very few people seem to be talking about, which will be a major disruptor to what Trump wants to achieve domestically, and that is the weather cycle.
just have it
We
here
are-
up on the screen.
Sorry?
We just have the chart up on the screen, fresh from your report, hot off the press, and it's themed all 4 US drought cycles are synchronized for the first time since the 1930s.
Yeah. What you've got is the mega cycle is the Gleisberg cycle, which is a 90-year cycle. The last 90 years ago it produced the Midwest Dust Bowl decade. So imagine what's that going to do? And it starts kicking in this year. I had an email from a friend in Pennsylvania. We chat about these things. He said, I've just been through my local superstore. Shelves are getting empty. The beef that should be there is only there in small quantities. The chicken is not there, so on and so forth. But you're going to see high food prices. I would actually say by 2026, soaring food prices. What's that going to do to markets, debt markets, interest rates? It's going to be an extremely difficult issue for Trump to overcome and at the same time achieve what he wants to achieve, which is the regeneration of America. So food is not just going to be in America, it'll be global. How much food does America export? These weather patterns are on the point of changing from warming cycles to cooling cycles. And I'm going to read, if I may, a couple
Please
of
do.
paragraphs from the person that I follow called Sean Hackett. And this is what he wrote in his Money Flow Commodity Report. Right now, the Atlantic Ocean has been in the 40-year warming cycle phase that has been primarily responsible for warming the planet over the last 40 years. That cycle ends by 2025 and will usher in a 40-year Atlantic cooling cycle phase that will reverse the current warming effects. What bothers us is that the last time the Atlantic cycle turned cold was 1965, and the impact to cooling the planet was severe and caused accentuated weather volatility, shorter growing cycles, later spring frosts, and earlier fall frosts that played havoc with food production. We did not have a quiet sun back then. We do now. And that means that both the sun and the Atlantic Ocean will be pushing a colder climate trend simultaneously for the first time since the early 1600s. We also have the Yoshimura planetary temperature 60-year cycle and the big Gleisberg planetary temperature 84-year cycle, causing additional weather spikes, troughs, as in the 1930s. The synchronicity of all these cycles was last seen at the beginning of the 1600s. So
Life-changing
it's another cycle that is emerging. And it's one that few people are paying attention to, but they should, because food prices are going to be, the food supplies are going to get tight, and food prices are going to soar, not just in America, but globally.
And Simon, if I could ask for a little background, especially to let's say the younger audience, but also maybe just to those who are less aware of the 1930s Dust Bowl. What was it, and how did it become impactful to the economy and to people?
Well, it caused the Depression. It was a major cause of the Depression. No food, no supplies. People couldn't afford things. It's a major disruptor to economic activity and the way one lives one's life.
So certainly a worst case scenario ahead, and one that was experienced in the 1930s and is well known, the Great Depression, but more specifically the nuance of the cause effect from a weather perspective, and the interesting insights just shared there from the scientist that you follow as to why he's concerned this year. It'd be great to also add the work of Dr. Raymond Wheeler, who's one of the weather cycle pioneers recognized by the Foundation for the Study of Cycles. So look up his work as well if you'd like to read more. But one question I'd like to ask Simon is certainly it's clear if and when such an extreme event were to happen, it would impact lives, it would impact the economy, and it would certainly impact markets. How does this play with your inflation expectations? And here we have a chart of 1970s inflation resurgence. That's the red line CPI overlaid with here and now. And we can see the pattern seems to match. And when we last spoke about this in-person catch-up in Dubai, you very wisely reminded me that you lived through this experience and know it very well. What was that experience back then? How do you see it playing out now? And this whole sequencing inflation and inflation, or whichever way around, how do you square that in your mind?
Well, I think the causes of inflation: too much liquidity, wages rising. I think there's a trend towards a greater share of wages to capital in corporate balance sheets. Food prices will be rising very sharply. I think by 2026, you won't be having falling oil prices. You'll be having rising oil prices, despite what President Trump wants to do. We'll see disruptions, more sanctions. And to give one example, more sanctions against Iran. They're focusing on the tanker fleet. So maybe China doesn't get the oil that it has been getting from Iran, but that can be replaced by oil from Russia. But I think that you're going to see oil prices by 2028, $150 plus. So an inflation cycle feeds on itself. Once it starts, everybody starts hedging. You buy more that you need for the next week or day. Companies stock up. I'll take copper as an example. The whole manufacturing supply chain builds inventory. So copper prices on our work will go from, say, $7,000 by September to $14,000 by the end of 2027, to give you the sort of example of what we're going to see on the inflation cycle. So,
And inflation itself and interest rates, what's your view? You mentioned at the top, but if we could
well,
redirect to
we,
viewers.
we will. I think we will see US CPI at least, that is to say, the officially reported CPI, because the real CPI is much higher than that. If you look at the work of John Williams of Shadow Government Stats, who takes all the manipulated processes that have taken place by different governments since Arthur Burns in the 1970s, his work shows that actual CPI has averaged 10.8% last year. So just using the official CPI, we're going to see it over 13%. World inflation, 15%. That is a repeat of 1980. What does that do to interest rates? Long-term interest rates over which central banks have limited control. They'll be in double-digit figures. What will double-digit figures do to a highly leveraged, indebted global system? Will crash it.
And just to quickly spotlight that chart again on the screen, US CPI here and now compared to 1970s, themed rolling waves of inflation volatility, and that inflection point that you just alluded to, Simon, where you get a two-stage pattern down, perhaps asset price deflation, and then, of course, the resumption of the structural inflation. But that's the straight line up that you alluded to into double-digit territory.
Yeah. That's a lovely chart.
So certainly a historical rhyme to watch. Repetition, not each time, but certainly something for us to keep in mind as a probabilistic roadmap. And for those who are looking for the strategy in such a challenging environment, particularly if it's inflationary, many might be saying commodities super cycle ahead. But first, I ask you the question, Simon, sooner or later. Here we have a ratio of commodities versus equities. So the line going down is commodities underperforming equities and vice versa. And certainly commodities are super cheap, relatively speaking, and overdue a snapback as part of this rotational leadership that may be ahead. We're already seeing that in precious metals and some other markets to follow. You mentioned energy, certainly the food sector, if and when we get some weather change or some weather shock. What's your perspective on the rotation of commodities and equities and the commodity super cycle itself?
I think we're not in the super cycle yet. We won't be because global business activity in the first half of the year, or the first 9 months, is going to be weak. So we're going to see base metal prices anyway falling from where they are today. But I think we then will have a 2-year boom cycle in commodities. But given our view of what's going to happen post 2028, you won't be in a super cycle. You will be seeing metal prices, i.e. base metal prices, at levels that today would seem unfathomable. But the real super cycle starts in the early 2030s. That's when we see global GDP going back to its historic average since 1900 of 4% a year. And that will lead you into the super cycle.
And certainly, I mean, many years ahead, but based upon what you said, but I was just thinking as some of the contributor factors, from a relative perspective, equity market underperformance and that shakeout that you're expecting, also inflation itself, depending on how it may rear its head in the coming year of 2025 and beyond. And then lastly, the dollar. But before we jump to the dollar, if we could touch on gold, such a extraordinary performance in the year that has passed, 40% from low to high, outperforming equities by 10%, and certainly the signal of inflation, currency debasement, and so many other safe haven drivers. Here is a historical chart of of gold during crisis periods, spiking at least twice. Once was in the 1980s, and the other is in the mid 1970s. Those historians will know, of course, we had macro risk in terms of economic, but also geopolitical. Simon, what's your perspective about gold in general, in terms of its already impressive performance, but also this likely acceleration if and when we get further macro risk ahead?
I think it's inevitable that gold prices for the next 10 years anyway will be in a rising trend. Obviously, it won't be a straight line. But what we're seeing is central banks diversifying their assets out of what one might call fiat currencies into a solid asset. I think the big driver in gold, not necessarily today, is that China and Russia hold much larger tonnages of gold than they report. Since the Shanghai Gold Exchange was formed in, I think it was 2002, China's citizens and institutions have bought more or less 25,000 tons. I know, and I can't tell you why I know, but I do know that China's ministries, not just the PBOC, but especially the PLA, also hold very large tonnages. And the last count that I saw was another 25,000 tons. So if China's currency came under severe pressure, I think you will find that there will be an announcement from China that China's currency is supported by the gold which its citizens own. And I think they'll give out the number, that's my guess, 25,000 tons. Russia, the figure that was given to me 3 or 4 years ago by somebody who should know, is that Russia's total gold holdings were 12,000 tons. Most of that gold is held by the company that sits above the central bank. I've forgotten its name. So I think within a number of years, if BRICS is allowed to mature, I think that they will develop a currency based on gold. I mean, take a simple example. You are a producer of copper in the DRC or in Zambia. and you've received dollars in return for the copper that you have sold. Those dollars have not held their value. The 1980 dollar today is worth 25 cents. So you can argue that the profits that they have assumed they have made are illusionary. So I think that the ultimate objective is to link the BRICS currency to gold. Don't ask me when, maybe 5 years' time.
Interesting scenario ahead, and certainly it's plausible in terms of the latest developments. Here and now, looking at the global reserve currency of the world, the US dollar, sometimes referred to as dollar king. If and when do you see that losing its crown this year or beyond? We see here a chart of the dollar index rising for the last decade or so, making a peak in 2022 when we had the shock in inflation and rates, but also stronger growth numbers and broader rate differentials versus other markets. Since then, from a behavioral chart perspective, the market topped and has been sideways ever since. Now, of course, for the last few months, we've had a rise in the dollar. This is this is an archive chart that I'm showing, so it's not updated, which moved back to point B from the right side of the chart. But there were at least 2 occasions we tested that line in the sand psychological level at 100. If and when we were to retest that level again, Simon, what are your expectations of the US dollar? So there's a lot of dollar bulls out there, particularly into Trump 2.0, as part of that revival of animal spirits, pro-economy, and ultimately euphoric expectations of a new leadership ahead. At the same time, we also have trade tariffs, which include the dollar itself for countries that decide to play a beauty contest between one and another. What's your view on the dollar index and the dollar in general, but also some of the macro policies that way?
Yeah, I think on the dollar index, we have it peaking at around 110, which we'll probably see in the next few months. And from there on, the trend is going to be down. And on our work, you'll probably see the end of 2025 closer to 90 than 100. And at the end of 2026, 80. And then closer to 65 in 2028.
So sizable risks ahead.
Yeah. And I think, there are people close to the Trump camp who say actually Trump wants a weaker dollar to help exports. But the trend is there. And the trend is very simple. And that is more and more trade done between BRICS countries excludes the dollar. That's a lot of dollars.
And to close, Simon, one of your special focus areas, China, through all that it's experienced in the last year alone, did have, in terms of headwinds, did have a strong upsurge, certainly in terms of the equity market, and still those macro risks remain. Looking at this chart of both the CSI 300 Information Tech Index and Shanghai Composite, certainly we see when it's normalized and looked at from a big picture, long-term perspective, it looks sideways to bearish, but a potential inflection point ahead. In Elliott wave terms, this chart is developed by Elliott Wave International. There could be a impulsive wave 5, which is positive, but typically is a grand finale scenario to the upside. What's your perspective on China as your special focus area, the headwinds that it's endured, and potential upside surprises ahead?
Well, let's talk about the economy first, and then the Shanghai Composite. I think the big change that has taken place in recent months is that decision-making, instead of being of a singularity process, is a multi-process. In other words, instead of President Xi making the decisions himself, the leadership makes it jointly. Because of this change, you are going to see much more fiscal and monetary expansion. Most of these new measures will be announced during or just after the NPC meeting in March. So I expect to see China's economy recovering sharply in the second half of this year and into 2026 and 2027. And the economic recovery in China will then lead off into better economic performance globally. The stock market, when I recently had a good look at what my technical advisor was saying on the stock market, and then when I looked at stock market cannot be the Shanghai Composite cannot be looked at on its own. It's part of the global equity market. So we came up with the conclusion that the trend of the Shanghai Composite is going to be very similar to the trend of America's and global equity markets. So we are approaching a top in Shanghai. We have a sharp correction, and then we have a bull market into 2028, and then the big collapse. Very much the same as global equities. But the big story is don't be so bearish on China's economy. It's actually not as bad as it's being made out to be. Consumer spending is rising by 10%, which is what it has averaged over the last 20 years, 10.4%. The property market is probably bottoming out. I think the debt has been isolated. Slowly, consumers coming out of their quiet period, but in this quiet period, the patterns of consumption have been quite different. It's been, for instance, if you look at what's been happening to domestic appliances, they've been booming. So consumers have said, we're not moving house, we're staying here, let's improve it. So you see the air cons, washing machines, and fridges have been extremely strong. Travel has been strong. Shopping it used to be the case that people were proud to be buying the big fashionable clothes and handbags, etc., that the West sold into China. Now that's not the case anymore. Why should we buy that when the Chinese stuff is just as good? And the price differential is huge. Look at what China is doing in the auto industry. It's destroying Europe, and if allowed to, would destroy America's auto industry. It's not just on price, it's on quality. I mean, was it 2023? That's right. A friend of mine was in the German delegation going around the Shanghai Motor Show. And afterwards, the message I got was, we're beaten. They were just stunned at the quality and the price. People forget that China has developed the most efficient and sophisticated supply chains in the world. It's not just subsidies. There's no more subsidies than in America or Europe. It's just that they're efficient. Their robotic population is the sum of the next 10 countries. They've been automating for years. I mean, I can remember in the mid-1990s going around a new factory. I probably saw half a dozen workers. That was a long time ago. So China is the manufacturing hub of the world. I mean, there is talk that part of Trump's policy of breaking up BRICS is to offer China, let's make it a duo, you and I, and we will control the world. But I think the multipolar alliance of the BRICS countries is too strong to be broken.
Interesting themes ahead. And Simon, if I may, as a final wrap and recap, what strategies do you recommend investors consider over the next 6 to 12 months?
Play the short cycles. Don't think about long-term investment. Bear in mind that food prices are very likely to take off. So if you're running a household, make sure your fridges are always stocked up. And these are short-term cycles. You have to play them. Forget about long-term investment.
Well said, and certainly thematic and timely guidance. Simon, for our viewers who would like to follow your work, where can they go?
Either at simon-shss.com or simon-hunt.com.
Wonderful. Thank you very much, Simon, on behalf of the Foundation for the Study of Cycles. It's been an honor and a pleasure to discuss world markets, world affairs, and various scenarios that may play ahead.
Well, thank you very much for having me. I enjoyed it very much, Ron, and look forward to seeing you in Dubai.
I look forward to catching up again in warmer climate.
Cheers. Thanks a lot.
Thank you very much.